God bless everybody. It's January 4th of 2024. This is a business update on what the markets could possibly do tomorrow, and I wanted to bring some of these things to your attention. I am not an economist, but I have followed the markets most of my life, and so I've been watching the markets through multiple crashes and recessions over the years. Actually had to go through part of the Y2K thing when I programmed back in the 1980s, and we knew that there were going to be problems when the date clock went from 1999 to 2000. That was a really big problem with the Julian dates, and that was going to blow up all the systems and all that. Had to deal with a lot of that, and so I've been following the markets. I used to program for banks and build home mortgage loan systems, so I know a lot of how the banks work, how mortgages work, and how they manipulate your money through that process. But let's look at what potentially could happen tomorrow and how this could be a real problem as we walk into the weekend. And we have some other reports coming out later in the month that will matter to you. So the markets have been struggling lately. And the reason for that is at the end of last year, which was just a few days ago, the markets had indicated, because there was strong job report last week, and that was going to allow the Fed to basically start cutting rates sooner, like in March, and that they were going to get potentially 6 cuts in a year, which is ludicrous at best. And why I say that is until they can control core, and core starts moving down to 2%, which has not hardly moved at all. There are some other indicators out here that inflation's moving down, but food, rent, housing, different things like that, all that stuff's moving up. So anything that you really care about is moving up in your inflationary target, and that's a problem for you because we're moving into a time which is going to be under a lot of distress as we move forward, and you're going to see a hyperinflationary environment as we walk into the next month or two here. Now, I've been talking about this for some time because this is your third seal hyperinflationary event that's coming up, and this is probably your third leg down that I've been talking about. So what's going to happen is, if you get a strong job number on Friday above the 190,000 that they're basically telling us that we're going to get, let's say you get closer to 300,000, that will be a real problem for Jay and the Fed, because that means his market's extremely in good, the economy's in good shape because we're putting a lot of part-time jobs in people's pockets right now, which are not necessarily good because they're part-time jobs and not full-time jobs. And anytime you get a job, they record it as a full-time job now, and so the numbers are skewed out here in a lot of ways, and so you need to understand that to begin with. But if they get a 300 or even close to 250 to 300,000 print, this is a real problem because Jay won't be able to cut rates, and the markets will also react to this. So this report came out, and I just had talked about how the bonds were going to melt up in a video, last video or two. The markets will melt up, and what will happen is the 2-year will melt up to a certain point, let's say 5 to 6%, but the 10-year will melt up above it. Renormalize your curve so it's not inverted, but yet your 10-year has moved up to a 7, 8, 9, or 10, which would then force all of your home loans and all your loans out here to be double digit or higher, which is going to cause everybody all kinds of problems. And this then takes you back into like the 70s and 80s when people were paying 14, 16, 18% on a house loan. And if you do not have a fixed 30 or 15-year fixed loan, and you've been using these predatory banks, these regional banks that only give you a 7-year loan, and then you have to redo that loan basically 4 or 5 times before you get it paid off in 30 years, which means they can reload that interest on the top. Every time they go back in and redo your loan, they can reload that interest on the very top of the portion of that loan, and you don't know what your rate's going to be. Well, if you go in and let's say you've got a loan 6 years ago and you have to come back in this year and redo your loan, and your loan back then was like 3 or 5% and now it's going to be 14%, you may not be able to keep your house because you can't afford to do that. And the bank puts you in this trap. This is a trap that the bank does so that they can get your money out of you, and in hope that someday they can probably own your house if you fail in this process. So what he's talking about here is, and you're already starting to see certain markets react to this, because this will happen tomorrow morning and it will react throughout the day to Friday and to Monday of next week as we watch these bond rates spike up or melt up. Okay, and that's bad because they've come down quite a bit. But I've talked about how that can't happen forever. They're going to have to come back, and when they do, they're going to come up with a vengeance because they're not getting their mandates. And they've thrown so much money in liquidity, literally $10 trillion in the system since Joe Biden took office, and now we just crossed the $34 trillion mark on the debt on the books that we're paying 5.5% interest on every month. So I had to bring this to your attention because this is a guy that gets it out here. At least I do. And maybe this won't happen. Maybe the bonds won't melt up. Maybe the job numbers will come in weaker than 190,000 and we won't see a spike in jobs. But you have a lot of government jobs being created, because that's where all the jobs are basically being created right now. If you go out and look at the numbers and you pull up the hood and actually look at the numbers and see what jobs are being created, they're creating a lot of government jobs. A couple months ago, we had some revisions due to all the strikes and different things like that, so the numbers looked a little softer back then, but they've been increasing since. We've had a strong market in the sense that due to hyperinflation out here, more people are going out and getting part-time jobs, and so that records as a full-time job based on the way they skew the information now, so it makes them look like they have low unemployment. Okay, Joey can't have low unemployment if he doesn't have people working. But what he's doing is he's recalibrated the system to where he's using, people are going to go out and get 2 or 3 jobs now to keep paying off the debt that they've just acquired in the last 2 or 3 years through the COVID spikes and all this stuff by buying new cars, and inflation's up and rent's up and school loans are coming due and people are paying, more for food and different things. Fuel's getting ready to respike with the Red Sea out here. So it's nice to see that this guy gets it. And I've talked about this. This is a hyperinflationary mode that we're walking into, not a deflationary mode like everybody seems to think. The reason the bonds fell recently is because the Fed came out and confused the markets by saying he didn't know if they had to raise, but they might leave the option open. But it looked like maybe they had soft landings and pillows, and they were going to get their soft landing, and they had basically done their job, and he was lying to everybody out here. Okay, so what would happen is if we have a high job number, we're going to see the bond spike. It will melt up. This guy's talking about it could potentially melt up 15 to 20 points if you look at what he's talking about here. He's talking about a parabolic spike up. This will affect the 10-year bond, which will affect everybody's loans, mortgages, credit cards, cars, housing, everything out here. Because the 10-year is what they write your loans off of. Even the 7 years, they look at the 10, they look at the rate. The Fed follows the 2-year rate. The banks loan or borrow at the 2-year rate. They loan at the 10-year rate. And when it's inverted like it has been, the banks can't loan, and that's why they've restricted them so much. My fear is that this will recorrect and uninvert. And if that happens, you have a severe problem, because the 2-year could be at, let's say, 5. It's at 4 now. It could go to 5, and then that would be a problem, because that means the 10 would go above it, because it would uninvert. And then what would happen? It would normalize with a higher rate at the 2-year and a much higher rate at the 10-year, and that is your normal rate now, not 2%. It'd be more like 4 or 5 or 6% on the 2-year instead of the 2 that they've been trying to get to. And your 10's at, oh, I don't know, a 7, 8, 9, or 10% rate, which is what the banks are using to determine what your loans are. And so you would be charged at 12, 14, or 16, or 18%, depending on regional or larger banks. And so you're going to get smoked here in 2024 real soon, because the markets are getting ready to capitulate, because they can't take this kind of stress. It's ridiculous what's going on out here, and they've been working these numbers forever. So if you get a large job number report like this guy's indicating, you could potentially see this really melt down in the next week. And the bonds would melt up, and you would see potentially the markets melt down to a certain degree. I'm sorry I have this little thing on the screen here, but I'm not subscribing to Bloomberg, so just it is what it is. But it was a good article, and I wanted to bring it to you. So here's what he's saying. Right now you're at about a 3.99 yield. Okay, so you're at 4%. He's talking about the spike into potentially 4.20. That is a huge spike or tail in one day, moving upwards or melting up the 10-year bond. It's a huge spike. You don't see these kind of spikes, and when you do, you know the markets are in trouble. So Friday's report is expected to show that the U.S. employers added 175,000 jobs last month. And you have to determine what kind of jobs they are, government, private, or otherwise. With the so-called whisper number calling for an increase of 185,000 positions. So they're looking, and that's a fairly normal thing to have about 200,000 jobs created, okay? But because you have this huge influx of part-time jobs, because people are having to go out and deal with this inflationary environment we're in and having to get a second or third job or whatever, you could see a pop in this number. And if you see a pop in this number of between 275 and 300,000, this is going to cause a real problem, because it's going to force the unemployment rate down. And Jay's going to say, I'm not stopping the economy. I'm not shutting this down. We're going to have to raise rates again. We can't stop the raising of the rates. We're going to have to continue to raise them up to that 6% that I talked about. That's what his original goal was. He's going to end up there. I'm trying to explain this to you for some time. It takes time to play these things out. Just like when I told you that Dogecoin was going to go from like whatever it was to 8 cents, and it's been there forever. Well, this is going to play out, but this one's going to play out soon. Probably in the next few weeks, as we watch this all get ready to go down. And you have those dates between January 6th and February 5th that I've been warning you about on the paradigm. This could get really bad. So if you add 15 to 20 basis points on the 2-year bond, this is a real problem. And I just wanted to let you know that tomorrow through Monday or Wednesday of next week, we could see a lot of destruction in the markets, especially as they're trying to weed out this process. If you have a light number or an average number of about 185, 175,000, then the markets won't react to anything. If you have a really weak number That will then signal Jay that he's done his job because he's created a ton of pain, and it's going to accelerate into the new year. So you could see negative job growth over time. And Jay's then going to have to start reducing rates immediately because he's offsetting. And we watched the 2-year bond drop below where he is because he's at 5.5 and the 2-year bond's at like 4.385 or something like that. So keep your eye on the markets tomorrow. This one could get interesting. You got a 10-year bond sitting at 4. That could push to 4.2 or higher. Might not be that high. You may not go to 4.2. If it goes to even a 10 to 15 basis point move would be pretty extreme. And then you would have to wait through the weekend to see what's coming up on Monday. But this could really affect the markets on Friday. And remember, this is the 10-year Treasury. So when you go to the 2-year Treasury, you have a spike of, you've had a 4.387. But what I'm talking about here is this will move up, but not as radically as the long end of the curve. And when the long end of the curve moves back over the top of the 2-year bond here, then what you have is a normalization of the curve because it's not inverted anymore. And it then levels out at whatever level it is at that time, okay, which is about 4 to 5%, which is 3%, 2 to 3% over where the J wants to be and where he wants core to be, which is around 2%. So he's just screwed. And then if this gets to the point where he loses control of this, regardless of what the bonds do, and they spike up, let's say melt up to where I've been talking about here in this video, he potentially would have to cut rates to 0 and because he's lost the game. If you see the Fed cut rates extreme at the last moment and drop them down, what he's trying to do is he's trying to restart his economy because he's lost control at the top end. And so what would happen is he drop these rates down, try to reboot the banks to get you to go out and borrow money and do what's necessary to keep this hemorrhaging economy moving forward, but it's too late by the time he figures that out and it fails. It'll just fail and there won't be any way to salvage this beast. The other thing I noticed is we had a number of countries move to BRICS in the last few days, and so that's going to be a weight on the dollar as it's disintegrating in front of our eyes. Couple things you should be aware of is we have a debt ceiling issue that could actually hit us twice. One on January 19th, and there's another one coming up in February, I'm pretty sure, because of the bills. If one bill doesn't do this, then it moves it down the road a little, so you got to be careful. That's right in the middle of that time frame between January 6th and February 5th, and so that's right around the 15th when I believe we could potentially see that siege on Jerusalem from all these proxies over in the Middle East, around the West Bank, Hezbollah, those different areas there. Another thing you should be aware of, we have a Fed meeting on January 30th and 31st. What numbers we see in the next few weeks on jobs and things will affect how the Fed is going to react on this date of January 30th, which is a really interesting date because I say that's a potential 6 seal event on these dates. January 30th when I have that date, and so maybe we'll see destruction on the planet as well as the global markets as we move forward. This could be real interesting timing. So just realize we have this meeting on January 30th and 31st. If you look at my paradigm, I show we have a 6 seal event potentially happening on January 30th. So that could be an interesting thing. Another thing I want you to be aware of is you have a spiking going on in Brent at this very time. It has moved up radically in the last week. It had gone down quite a bit. Then we hit a double bottom here. It shot back up. We potentially are going to see another double bottom hit here, and it will shoot up again. If you look at the chart, it's interesting when you hit these double bottoms, there tends to be a rise in price in a lot of cases. Okay, just realize it. It is a pattern. Charts are what you need to be looking at. If you want to know what's coming, you can look at your charts and they can tell you a lot of times what's coming in the future. And I brought this out through Bitcoin and different things like that. Even when I had made a comment that Bitcoin was going to hit like $15,000 to $12,000, well, it did. I thought it might go lower, but it might now. When we get through this process right now that we're going through on this leg and it's going to collapse, Bitcoin could collapse soon with this in the same process. And I'm watching Bitcoin not in a very good shape tonight anyway. So Bitcoin's already being affected. Tomorrow could be a rough day on all these different markets and different things like that. You had a huge parabolic spike down just in the last hour or so. It's starting to react to potentially what could happen as we move forward into these job numbers, and I say Bitcoin could fall at least potentially down to that 37,500 level again. That's where support would be, and so that's where I could see that going at this moment in time. But as a third leg, this could go down quite a bit. I haven't really charted it out. I'm just saying that right now that's looking like where we're heading anyway. Once we hit that support, if it falls through the 37,005, then it's hard to say where it could end up. Back down around that 15,000 mark. And that's what I was talking about. As this chart fell, I indicated that we would end up around 15, 12, 10,000, somewhere down in there. We ended up around 16. It wasn't too far off. Now you push back up to 43, 44, and you could potentially dump back down here again without any trouble. This is one of those things where if the normal markets fail, Bitcoin's going to fail, and then you want to buy all these commodities and stuff on the bottom at the fire sale. Last minute thought is on this, if the Red Sea breaks down like I believe it's going to, and they start shutting all this down, and you have at this point, I've seen shipping costs have spiked like 250% because they're moving this material so much further around the continent than through them and different things like that. If you have this breakout of this Hezbollah attack on Israel and this breaks down in the middle of the month around the 15th, this price could spike from $70-$80 to $150, $125 to $150 a barrel. And this is a hyperinflationary movement here if that happens. So I want you to be aware that, when you go on, you look at these things, and we've seen, oil up here. You've hit these double bottoms and they move up. I believe you're getting ready to hit a double bottom here, and it's going to move up tremendously. We'll see how that all works out. But if you have a breakdown in the Middle East and there's some major disruptions here in oil and different things like that, oil will spike tremendously. And they're already seeing it spike here just in the last month or so. We've seen it shoot up quite a bit. And so the fuel prices you're seeing right now aren't going to be there long, so it might be a good thing to go out and fill your cars up and your vehicles and anything that matters right now before this pops. Because if this does fall apart and you get a $125 spike or $150, or even if it goes over $100, your fuels are going to immediately move back up to where they were a year ago, and we're going to be in the same place, and it could get worse. Could get a lot worse. So just be aware of all these different things. I believe tomorrow could be a turbulent day in the markets. It will matter to the job numbers, and it will matter to Jay Powell as we move forward into the end of the month and through this period between January 6th and February 5th that I've indicated on the paradigm. All this stuff is culminating into a perfect storm. So God bless everybody. Find the open door. Find Jesus. Be safe out there. Fill your oil now, or you may not get the opportunity.